Hi, Beata Bukowski coming to you from Fairway Independent Mortgage with our weekly economic update. The Dallas Fed has published an article last week talking about a housing bubble. Are we really in a housing bubble? Well, in order for us to talk about a bubble, we would need to point where the bubble actually started. And the bubble means that prices would fall back to some time earlier, prior to that creation of the bubble, which would take us all the way down to 2012. Prices have gone up over 108% since 2012. So to think that for most of those homeowners who actually capitalized on the extremely low interest rates over the last 2 years, with currently having 50, 60, 70% equity in their properties, to just let go of those properties and sell way below the market value and go into renting? Not really probable. Also, why are we not in a bubble? Because of 2001 to 2008 was a speculative buying. What does this mean? Everybody wanted a piece of that real estate gain. Right now, the difference is people are buying to live in or to rent out, not speculatively. Additionally, as we all know, mortgage guidelines today do not resemble anything of what the early 2000s looked like. We will have to verify it. Those of you that have worked with us, you know how many questions we ask you on your financial status quo before we get you that loan approval and the money to your closing table. It wasn't like that in the early 2000s. Finally, the low inventories and the high demand that's tied directly to the demographic group that is in the buying mode, the millennials and the Gen X's, we're not in a bubble. That's my take on this. In other news, the employment report, highly anticipated employment report for March came out last Friday. 431,000 jobs created, so a very strong employment market. Unemployment went down from 3.8 to 3.6%, which is pretty much close to the levels from pre-pandemic, which it was reported at 3.5. On this unemployment level, typically when unemployment dips down and then starts ticking up alongside with the inverted yield curve on the short-term versus long-term bonds, that historically speaking has been the onset of a recession. We've got the inverted yield curve. We're looking at what will happen with the next month's unemployment data to know if we are in fact entering that delayed recession. Currently there is 1.7 million, a little bit over 1.7 million people collecting unemployment, which is substantially lower than the levels at the same time last year, which was reported at over 18 million. Personal consumption expenditures, reported 0.6 increase last month, actually in February, and that is an increase year over year from 6 to 6.4%. Inflation obviously is crucial to mortgage bonds, but also and directly to mortgage interest rates, and we have been seeing these rates substantially moving for the higher. They are moving for the higher also because the Fed rhetoric has changed a little bit, saying that they're going to have to be more aggressive in reducing their balance sheet and buying less mortgage-backed securities so that they get that inflation somewhat under control sooner rather than later. So from now on, we're looking at interest rates going higher. However, at recession or during recession, we typically see rates coming down. So no problem. Let's finance properties right now or refinance them when rates do drop again. Beata Bukowski, over and out.